Hi friends, should you do SIP mode of investing or should you do lump sum investing? This is a common question which is asked by most of the people, whether should they invest on a month-on-month basis, is it beneficial, or should they invest today on a lump sum basis, is that going to be beneficial in the future? So we are going to understand what are the key approaches available when it comes to SIP mode of investing and what are the key approaches which are available when it comes to lump sum investing. When it comes to SIP, there are two approaches which I'm going to share in this specific video. The second approach is going to be one of the most advantageous approach if you can do it in the SIP mode. And when it comes to lump sum approach, there is just one technique or one strategy of investing into lump sum. I'm going to share that as well, of when you should do lump sum investing. So please keep watching from the start to the end so that you can take advantage and maximize your gains based on these approaches. So please share it to your friends, relatives, colleagues, and as many people as possible so they can use these approaches and decide for themselves, how they should go ahead and do SIP or lump sum. And obviously, you can decide for yourself whether amongst this, whether should you go for SIP or lump sum today. So let's see what are the approaches available for SIP. In SIP mode of investing, you have decided what are the portion of investments you want to do, either in mutual fund or direct stocks, irrespective. You want to do specific portions of investment every month on month. That is your systematic investment plan. So you have decided like 10,000 rupees, you're going to purchase units of mutual fund or units of certain stocks which you have decided a portfolio upon. So let us talk about mutual fund. You take this 10,000 rupees on a month on month basis, you invest into mutual fund. This is called as rupee cost averaging, wherein you take advantage of ups and lows of the market. So if the market is high, if you invest 10,000, you get lesser units compared to when the market is low. When the market has fallen down, say 50%, you can get more units for the same 10,000. So that is your rupee cost averaging. So over a period of time, you get benefit because of rupee cost averaging. But nevertheless, when the markets rise up, you still are doing positions into the units of mutual fund. Now let us see, is it an alternate approach of rupee cost averaging compared to rupee cost averaging, wherein you can maximize your gains even further. So this is called as the value investing approach. In the value investing approach, you increase your investment based on the devaluation of the market. So when you invest, say 10,000 today at a particular price, you get certain units. If the market has risen, then your investment is not going to continue to remain 10,000, but equivalent portions deriving up to 10,000 of value. And if the market has fallen, say suppose it's dip 50,000, then you have to invest even more at that particular point of time to buy more units of that particular investment, so that eventually step by step you are still keeping your investment up to 10,000 of limit value of 10,000. So I'm going to share this with an example in the subsequent video. So please watch my subsequent video so that you can get benefit of this value cost averaging, which works out much better compared to rupee cost averaging. And I'm going to share a practical view of how to do it for yourself. I've explained, but however it needs a demonstration as well. Or if you need a one-to-one communication wherein you want to do value cost averaging of investing into mutual fund or direct stock, you can please drop in a note in the comment section. I will be glad to help you with respect to value cost averaging. So now you have this direct investing in stock. So direct investing in stock, you have just one approach wherein you just see whether the market is overvalued or undervalued or fair. Depending on your expected rate of return, you need to invest when the market is either fair or undervalued. If it is fair, your expected returns, if you invest at a fair market valuation, is going to be lesser than compared to when you invest at a undervalued position of the market. So please study the valuations of the market at the point of time today. Today it's considered close to going into overvalued position, but nevertheless it's ranging between fair to overvalued, and hence you can decide whether you want to put your entire lump sum today. And if you put it today, you're going to get a fair expected return in the future. But if you're going to wait and balance it out today, maybe invest into bonds today because bonds are cheaper and the prices have fallen down, go in bonds, and then later on when the stock market actually starts dipping at undervalued position, your expected returns in future in the stock market is going to give you better returns. So I hope you have understood how you can approach lump sum investing. And if you have liked this video, please subscribe and please hit the like button and